All right, let's talk about something that, on the surface, sounds incredibly dry: financial assets. But stick with me here, because what seems like boring accounting is actually a secret playbook. It's how you can see a company's true strategy. So let's dive right in. Kind of sounds ridiculous, doesn't it? I mean, how can having too much money possibly be a problem? For you or me, that's a problem we'd love to have. But believe it or not, for a huge corporation, it is a very real and very tricky challenge. Just look at this number. We're talking about 9,196 million euros. That's how much cash the airline group IAG, the folks who own British Airways, was just sitting on at the end of 2022. That's over 9 billion euros, and it made up almost a quarter of their total assets. Letting that much money just sit there, it's like owning a Ferrari and leaving it to rust in the garage. So why is this such a headache? Well, it really boils down to two big things. First, you've got inflation, which is happily eating away at the value of that cash pile every single day. But even more important is the second reason. Every single euro that's just sitting idle is a euro that's not being put to work growing the business. It's a massive missed opportunity. And this is exactly where financial assets come into the picture. They are the number one tool that companies use to solve this cash problem. It's how they take that giant pile of money and make it productive, turning what could be a weakness into a real strategic strength. So what is a financial asset, really? The official definition sounds a bit stuffy: a contractual right to receive cash. But think about it. Cash itself is a financial asset. A stock, that gives you a right to a piece of a company's future earnings. A bond? Well, that's literally a contract promising to pay you back with interest. It's all about these official, defined rights to get cash later. And it's just as important to understand what a financial asset isn't. A non-financial asset is a physical thing you can touch, like one of IAG's airplanes or an office building. Or it could be something intangible, like a patent. You own the thing itself. A financial asset, though, it's not the thing. It's a claim on future money. That's the key difference. Okay, this is where it gets really interesting, and it's the core of what we're talking about today. How a company accounts for a financial asset has almost nothing to do with what the asset is. It has everything to do with what the company plans to do with it. The strategy, the intention, that dictates the accounting, not the other way around. So every single financial asset a company owns has to get sorted into a category. And to do that, accountants ask two simple but really powerful questions. First, the why. What's our business model for this asset? What's the plan? Are we going to hold it forever, or are we looking for a quick sale? And second, the how. How does this thing actually pay us? Is it through regular, predictable payments, or is it something else? Now, depending on the answers to those two questions, every asset gets dropped into one of three buckets. If the plan is just to hold on tight and collect the payments, it's something called amortized cost. If the plan is to hold it, but, maybe sell it if the price is right, it's classified as FVOCI. And if the plan is pretty much anything else, like aggressive trading, it lands in the FVPL bucket. I know. Those acronyms probably look like alphabet soup right now. But I promise, each one tells a very different story about what a company is trying to do. So let's break down what each of these categories, these investment plays, really means. First up, we've got amortized cost, or AC for short. I like to call this the piggy bank strategy. It's the most simple and straightforward play. You buy an asset, say a really safe government bond, and your only goal is to hold it until it matures, collecting all those nice, steady interest payments along the way. So an asset in this bucket pretty much just sits on the balance sheet at the price you paid for it. Any wild swings in the market from day to day, they're basically ignored. So when you see a company with a lot of assets classified this way, it's a huge signal. It tells you they're playing it safe, they're conservative, focused on stable, predictable returns, not trying to make a quick buck. Next up is a mouthful: fair value through other comprehensive income, or FVCI. Let's just call this the art collector strategy. Think about it. An art collector might buy a painting because they love it and want to hang it on their wall. That's like collecting the interest payments. But you can bet they're also keeping a very close eye on what that painting is worth on the market, because hey, one day they might just decide to sell it. This hybrid goal is perfectly mirrored in the accounting. The asset's value on the books gets updated to its current market price. But, and this is absolutely key, those changes in value don't affect the company's main profit number.
They're tucked away in a separate part of the financial statements. This signals a much more flexible, long-term strategy. It's a balance between stability and being opportunistic.
And that brings us to our last category, fair value through profit or loss, or FVPL. This one's easy. It's the day trader strategy. These are assets a company buys with one main goal in mind: sell them, and sell them relatively soon for a profit. The plan isn't to sit around for years collecting interest. It's all about riding the waves of the market. Now, with FVPL assets, every little zig and zag in the market price, whether it's up or down, flows directly to the company's bottom line, their net income for that period. This can make their reported earnings way more volatile. So if you see a lot of assets in this bucket, it tells you the company is comfortable with speculation. They're taking on more risk, hoping for a bigger, faster reward. Of course, we all know investments don't just go up. The accounting rules have a plan for when an asset's value takes a nosedive too. This is called impairment. And just like everything else we've talked about, how a company reports that loss depends completely on how the asset was classified in the first place. So for our piggy bank and day trader strategies, it's simple. Any losses hit the main profit and loss statement, plain and simple. But for our flexible art collector strategy, FVOCI, it's a bit different. Only the losses that are related to the risk of default, what they call credit risk, hit the main profit number. Other market value drops are kept separate. See? Again, the strategy defines everything. So, why should you care about any of this? Whether you're an investor or just someone who's curious about how business works. It's because these categories aren't just tedious accounting rules. They are direct clues sent straight from the company that tell you all about their appetite for risk, their time horizon, and their deepest financial strategy. And really, that's the big takeaway here. A company's balance sheet, and specifically this little section on financial assets, isn't just a list of stuff. It's a narrative. It tells a story about whether the company is a careful, conservative saver, a flexible opportunist, or an aggressive trader. So now you've kind of got the decoder ring. You can look right past all the jargon and see the real intention behind the numbers. You can see the strategy that's been hiding in plain sight on the spreadsheet all along. What story are you going to find?